Okay, this is about how to handle Per Diem in Nifty payroll. So we are looking at Per Diem. The KRA rule is that the first 10,000 shillings per day of Per Diem is tax-free. So what you would tax is the portion for each day that is above 10,000, which is single day Per Diem minus 10,000, so taxable single day Per Diem. And then you add up all the taxable single day Per Diems to get the total taxable Per Diem for the month. For the purposes of posting to the payroll, you also need to have the figure of the non-taxable portion handy. So do this calculation in an Excel file or somewhere else and have the two figures available for the employee. Now there are three items that you can use to capture Per Diem in Nifty payroll. So there's a cash Per Diem, benefit Per Diem, free of tax Per Diem. So let's go to Nifty and activate them. So to activate, you go to payslip items, you come to off, and you can do a search here for Per Diem, like that, and say find. So there you are, the three: cash, benefit, free of tax. They are all off. You want to activate, so just activate one by one. Highlight, click activate, yes. It moves to FVC. There it is. Next one, activate, yes. Next one, activate, yes. So all three now are here. If we clear, we have our basic pay and the three Per Diems that we've activated. Okay, so now I want to show you how to capture the Per Diem in Nifty, depending on the situation that you have. So generally, your Per Diems will be best captured in varying. Varying is for things that change from month to month or only happen from time to time. So let me just use my first example person here, and we are going to give him cash Per Diem. Let's say the taxable portion is 10,000. I'll explain this just now. And let's say the non-taxable portion, let's say it's the bigger bit. Let's go down to free of tax here. Where is free of tax? F, Per Diem. Let's say it's 20,000. Okay, so let's look at the scenario here. So what are we saying? You use cash and free of tax if reimbursing the employee through payroll. So the employee used their own money, and now you want to process that Per Diem through the payroll. So from your calculation, the taxable portion goes into cash, and the non-taxable portion goes into free of tax. So this guy got Per Diem of 30,000, and that's how it is split. The taxable bit up here, and the non-taxable bit down here. In this case, used their own money. You're merely, you're refunding them through the payroll. So if we come and look at the payslip, let's look at just that guy. We process. The two entries will be added when you process, and they will affect. There we are. So there are your two entries. If we look at his payslip, the taxed bit sits up here, is added to gross pay, and also to taxable pay. And then, of course, it affects the tax. Then now only the net portion minus the tax bit of that will reach the person's net cash. Then the free of tax portion here lands inside here in full. I hope that's clear. In the second case, where the employee already received the cash, but you need to tax it through payroll, in this case, the only bit you're going to put is the taxable bit, and you'll put it in as a benefit. So let's go back there. So you're not going to put this cash element. So let's delete that. And this bit that actually the taxable bit, I should have deleted this free of tax portion. The taxable bit, the 10,000, should go in as a benefit. So that's the 10,000. So originally, this was as cash. So that it could reach, it was as cash originally. it was as cash so that it could reach his net cash. But now what we want to do is only increase his taxable pay and not increase his cash through the payroll. And because he already received the money, the non-taxable bit does not come through payroll at all. So if we come back now and look at his payslip and process, so these two will disappear, and what will be added now is the benefit only. So now you have the benefit. When you look at his payslip, there is no impact on his gross pay, which is where his net cash is calculated from, but it is added as a benefit so that it can increase his taxable pay. So it is taxed without paying him through the payroll. So those are the two scenarios that you have. So I'll put this into the notes of this video, so you can just refer to it so that you have some reference point in case you didn't pick it all up. Thank you.